Hey guys, yes, it's me, the market sniper, the crypto sniper, and the reset sniper. It's the market sniper's turn. Yes, different jacket, same meme. Yeah, I am turning 50. That's right, 50 years strong. And I've got a very interesting YouTube for you. I'm going to show you why I think we're at a key tipping point for a number of things. What's happened? The inversion yield. I'm going to mention oil. I'm going to get into the overall economy and what the inversion is. I'm going to show you a number of things. But first things first. A gift to you for 50 years of me being around. Behind me, that seems a long time. Halfway to becoming a seriously old man. Yes, indeed. The Facebook group that we have. 50 of you on this channel that come on board and ask to join will be admitted not only to the channel where you will have amalgamation of all our best content, YouTubes from all the channels, blogs and materials that we will push through, often some of our best tweets and information and updates. And on top of that, you will be eligible for our trading session that will take place on the 5th of May. 5th of May, where we will see traditional markets. You can watch us trade and analyze the traditional markets. You can get a little bit of a feel about what we do with the rest of my amazing premium community, which I'll refer to in a bit as well. I'm going to show you one of them's charts. It's absolutely amazing. So proud of how these guys are developing and growing and trading. But for the birthday gift to you, come and join that trading session. 90 minutes, traditional markets, oils, commodities, FX, you name it. It'll be on non-farm payroll day. We'll see the data come in. We'll have a half-hour lunch break, and then I'll come back to those of you that are interested in cryptos and do crypto finds. Absolutely no charge. Normally £200. Normally £200 to come and spend just a free visit with us. And you can be part of our long-standing community. Interact, go-to-meeting link, really cool environment, kind of like this, good audio, all the good stuff. Or as part of a gift for being on my channel and supporting me, and I appreciate you for the market sniper. I'm going to show you, let's show you what we want to show you. Let's get straight into that. I will post the link in the notes below for requesting to join the group, and you'll be approved. And as I say, the first 50 will get the go-to-meeting links a day before the event, which will be the 4th of April. Okay, let's have a little look at a couple of things. Oil. So this is WTI. So that's Western Texas Intermediate. It's not all oils. They're different. They have different sulfur levels. Some are heavier, take more refining. Some are light. You might have heard the phrase light sweet crude. Intermediate means more heavy. There's sulfurs. There's various things that goes into the refining process. It means it's more work to clean up to get to a final product. But anyway, WTI is a big one. It's Cushing's, Texas. But most of Europe will be on Brent, so there's differences. But let's not get too hung up on the details here. This is WTI. What did we have? We had an inventory shock. And it was interesting that the inventory shock was, oh, we got too much oil, and it actually saw the price sell off here. So this is quite a big time frame. That was yesterday, and it sold off. You'll also note that I'm showing you a little bit of TA. You might see the fall from 78, which was absolutely quite a big surprise. Came out of nowhere on a little shock of weakness in the global economy. I call this the Rockefeller tax. It's kind of like when things are growing strong, how they skim us. When they've created a lot of liquidity in the market and everyone's feeling flush and your house is going up and it's your ATM and you're buying a new car and you're remortgaging and all of that stuff, they push the Rockefeller tax up. You pay more for your oil. It's in everything, transport, plastics, you name it. It's a nice general global tax. You can tax people all over the world with the oil tax. Anyway, now we had the Fed. The Fed said we're a long way from neutral rates in October. We said in July, these guys are going to make, market's going to make a high and probably start tipping in October. There's no way that the US could diverge and go on an interest rate tightening while the rest of the world was stagnating. Draghi, all the risks to the downside recently. Then, of course, the Fed flipped. They flipped and they started to U-turn. And they said, no, we're actually quite close to neutral rates. Beginning of this year, I think it was maybe December, Jan. And then recently, we're done hiking altogether for 2019. And now Yellen and all the others with the yield inversion. We'll come back to that next chart, yield inversion. But this is one to watch. Why? Because what happens is when the economy is perceived to be weak, they have to quickly cycle back the tax that they're laying on everybody because people ain't spending, they aren't doing anything. They need to take some of the heat out, demand drops, etc., etc. So was that over allocation of inventories. That's, in other words, pointing to less consumption. The first warning in what is, wait for it, let's get the draw tool up, what we call a rising wedge. What could happen next? Well, here's what typically happens, and this is what you'll find out generally. You can see when you're getting tightening, it means there's a lot of constriction along the lows here. The buyers are coming up fast on any dips, real fast, and there's kind of tactical. The supply line is letting it come up, but is still distributing into the highs. Now we've got another point of a high and a pullback. So this is squeezing. That's the whole principle behind rising wedge. What could happen? Well, sometimes what happens, one of three things actually. You could melt up, very uncommon, but you could melt up. I will put the probabilities on that, in my view, at the 5 to 10% view out of 100. So not highly likely for me. The alternative, however, could be the following. Let's take that option away. Oh, rather not. Let's do different colors. Let's do different colors. Let's play. I feel like a child. I feel like a child again. It's such fun. Yeah, we're really investing in getting nice, cool tools. We're showing you what we think about the trading world. So the other aspect, I'm making this a bit thinner so it doesn't get too crowded, is a pop out the top because there's a squeeze and these buyers are getting really, you know, kind of anxious and twitchy, and they get a little bit and then they crescendo and then they all puffed out. Pop out the top and then a collapse in the oil price like that. The final one, which is probably the most straightforward and is what traditional technical analysis typically does, pretty in pink, he says, is you just go straight into the collapse while within the wedge. I find practically in the practical world you do often get, let's change the color one more time so we stay consistent, we go to black, you do often get that little, whoopee, select him, that little blow off moment, which just spoils it from a trading point of view, because you want to go short. So overall, these two options are making up the other 90% for me. I see a return pool. There is actually, in kind of a weak fourth option, let's use the black, is just congestion. And that'll all be part of the 90%, these options. So that is 5 and 10, these are all. But I would say these two bare ones over here will get at least 65% of my vote. So if we're showing up here on May the 1st, my guesstimation is, given where we are today, round about the end of March, the final 2/3 of March, is that we will be lower or congesting in the oil price, and more probably 65% of that in the lower camp. In other words, there's going to be an easing in oil. Why? Because the economy is weak. Let's talk about that weakness and the inversion on yields. Okay, let's have a look at the 5-year yield. In Acapulco, I spoke about the fact that we have a method and that we actually had an inverted type structure on yields that implied that rates were going to go down. Since then, this is what's happened to rates. Down. This is your 5-year T-bond. So this is American government debt. They have so many names, they like to confuse you. Don't be confused by it. It's all the same thing. It's just the debt instrument issued by the American government. T-bills, 5 years, 10 years, US government bonds. They're all the same thing. It's a debt instrument. Don't be confused by it. What's actually happening when the yield goes down, guys? Whoops, let's go draw mode. When the yield goes down, as it did here, breaking key moment there, that would have been your entry on your short, bit of congestion, proper spillage as the Fed starts doing its U-turns and panicking. The key element of this is the bond value goes up. So let's just write that down. Some of you may not understand that. It's an inverse relationship. It's paying less interest because the capital to buy it has grown. More people are demanding it, the price has gone up, but the contract that it pays is still the same. So the relative interest rate that you're getting for that higher amount is dropping. Yes, I don't know if you understood that. I've done a podcast on bonds, and you can go grab that, or maybe I'll drop the link in this YouTube for you to watch it if you want to understand that a little bit more. It is the real bubble. It is bigger. Debt markets are bigger than equity markets, folks. People don't understand that. It is bigger, and governments are issuing debt on an unheralded scheme. America spends almost twice what it gets in tax receipts. So this has made target for a while. What will happen is, here's what's going to happen, prediction, is that the yield fervor and all the comments about it, by the way, 7 out of 7 times that the 3-month debt is actually yielding more than the 10-year debt instrument. That is what is called a yield inversion. The yield rate is inverting. That means short-term money pays you a bigger savings rate than long-term money. Typically, the debt should go, interest should go up with the longer duration. In other words, the expectation is always inflation because they proliferate more money. That's the cartel that we're in. They continue to proliferate and expand the money supply. Inflation means you have to earn more and you get dragged into tax brackets, higher tax brackets, and that's how they continue to squeeze us. They don't have to do lots of tax hikes. Actually, they give out cuts every now and then because everyone is being dragged into higher tax because the cost of living is going up. That's caused by proliferation of money. So typically yield curves, the longer, go up because there's a natural underlying inflationary element. When you invert, it means fear. It means more people are buying the debt and getting out of other assets. Why? Because it's the safest thing in the world, the government debt. Only it isn't. Normally it is, not in these times of extreme debt. So it is the Pavlovian response. So that's what's happening on the 5-year. Let's look at the 10-year. I'm going to show you a bigger time frame. This is a bit of analysis as well. You can see the context of this. So for those of you that like a little bit of charting, we've been suspicious for a while. As I say, we spoke in July of 18. We would have been around here calling for October to be near the absolute nadir when things would start to turn down. And I said, beware October. So when we were here, we spoke of this point there. Why? Because it was 34 months. Almost 3 years from the first interest rate hike back in, I think it was 2015, in December 2015. So that brought you to October of 18. And we said, you should start to see the signs of a recession coming in. What's it done? Well, we ended up with double top here, chaps and ladies, a double top on your yields. That means the debt was paying its highest interest rate, and since then it did a. Let's actually clear that a little bit. It's a nice little, also a weak head and shoulders in a kind of way. You can see that you got a double top head, but either way you played it, that was by HVF method always a horizontal line, your neckline. What does it give? A target down there. Because it's the first in a new trend and it's a clear topping signal, it may overperform, close 60% at that point after going short at this point. There's your two sniper, and leave your 40% residual for overperformance management. That's what you would have been, that would have been your trade on yields. So let's clear that. So that's where we are now. We've just run this. So what do I think is going to happen? What I think is going to happen, this is a 10-year. It's a huge one. It's one of the most common. 30-year and 10 years are big. And then, of course, you've got the short-term money, which is the 3 months, which we've been talking about. The deduction of the yield of the 3 months from the others normally should have a positive value, not a negative value. Okay, so what comes next? Well, they're first going to want to put the genie in the bottle and try hide this classic indicator. So what they may do, the Fed, themselves, cheeky, through their subprimer dealers and the cartel of Goldman Sachs, etc., all the other Ivy League primary dealer banks, they may buy a little more of the 3-month debt themselves to create more demand, push its value up so its yield drops. When its yield drops and is no longer higher than the 10-year, it looks like the inversion of the yield has now gone back to normal. That's a suspicion I have. So after such a scale and high speed move, you're likely to get some form of reaction, but only for ISS for a while. So that is just the key thing about markets not going down in straight lines. Having said that, how was that baby for a straight line? Not too bumpy at all on the double top call on the October as top call. And you could have called it even a head and shoulder with the weak right shoulder over there with the interaction at. Let's move that value. I want to show you where that neckline was. Wow, we're doing bond stuff here at the 3% yield. You see, there's a method in the madness why I wanted to show you that. Key level of significance. Major round number. Bang. Okay, so that's a little bit about bonds and yields and what's going on. But here is the big trade idea for you. And this is what we've been talking about in our community, and I gave my guys a head up. And you are now retrospectively getting an update on some of our thoughts in that as part of the birthday gift, along with joining the group and getting a non-farm payroll and crypto fines. What are we looking at? We're looking at the SPY. So I've made this quite expansive. I can tighten it up a little bit, and there's also a fib there, which is illustrating the enormity of the snapback rally that the Fed has induced by their absolute U-turn. In other words, the same October I referred to, you saw that double top on yields in bonds. Let me introduce this to you. This is weekly, not daily, so the charts are slightly different. But where's that October? Where does it start? Roughly here. We spoke in July and did it, and there it was. That's when we were talking, and we were saying the 34 months are up here as we start to run into October. Boom, chaka-luck. There you are at the top of your equity markets. That was our friend Powell saying we are still a long way from neutral rates. He quickly changed his mind to saying we are no longer doing any further interest rate hikes at this point up here, after the stock market took a nice little projectile vomit to the downside for the better part of 20+%. You see, you think they're there to look after you. They're managing the asset class of equity for their billionaire mega equity friends. These are the people that keep them in their jobs. These are the people they serve. They do not serve you. That's why we have the most bent Gini curve of wealth ever in history. Yes, that's right. The Gini curve, income distribution, how much income versus the percentage of the population. And in actual fact, if we do it, I should do it the other way. The more wealth you go and the smaller the amount of the population, it goes like that. That's it. So the poor have that amount of wealth, the middle class that amount, the upper middle class there, and your mega zone up here, percentage of wealth to the 100% point. That is a hollowed out Gini curve. They don't care to fix that. They like that. These people keep them in their jobs. That is the great scam and the cartel. So they put heat back in the economy when this started to happen. Stopped their rates. Stopped saying, hey, we're going our own way. We're going to tighten and reduce the balance sheet. This guy Powell's single mandate when he came on that he kept repeating is he is here to reduce the Fed's balance sheet. That's his meme. Now he's done. He's done. No more interest rate rises, promise. Won't be doing it. Won't be dropping this. No more stimulus. No more, tightening. No more QT. So he quickly changed. So what have we got for you on this chart? What can we tell you about where we are now and why is it possibly an opportunity? So as I was explaining yesterday in a premium check-in with my good community, that is better part of 88% rally kickback, a real snapback which was Fed induced. Really, really powerful. Note that the only head and shoulder that performed is the HVF method one that you would have been short roughly there, down to there. But that's a moot point. So what's happening now? What's happening now? Well, let's clear this up and let's get into it. Whoop, close that and let's expand it. I want to just show you where we are now. Now, this is a weekly, so you've got to bear in mind that the current candle is only part complete. The current candle is only part complete. But if you were to finish as you are now or there around, what you would have, going back to the draw mode, is a rejection, a major rejection high here. Remember, we had a tap out there on the blue line, tap out there on the blue line, tap out there on the blue line. We tapped out there on the blue line and dipped back, and now we had an attempt at a marginally higher high. We are close to the all-time highs here. You've never felt so good, or maybe you haven't. There's never been such a big divergence between an asset class and the real economy as you are getting here. That is the truth of the matter. Anyway, rejection past the open all the way down to the close there. That's what happened on that weekly candle. So let's clear that. So you've had one clear rejection. What kind of candle is that? Some of you who are aware of candles might be talking about shooting star. Long, tall wick, short, lower wick. This candle body has vacillated between being a small green candle body and a small red candle body, and a doji, meaning very tight to the open and close. We'll see how it closes today. US market's still open, but essentially what you've got here is a hanging man, close to being a shooting star, body maybe a bit big, but more bearish, closed even lower than it opened by some way, so quite a rejection. And then another potential shooting star, the tall wicks to the high side. The tall wicks to the high side. So what have I said to my key community? That I'm going to let you get a small peek in today. A small peek in today. You're getting a free shot at where we're looking at. We are calling for an easing in the S&P of some reasonable scale. I don't think it's going to run this. This is not the big one yet. This is part of what we suspect may be some form of consolidation. So there will be up legs and down legs. But this is a weekly chart. So this coming down to here will be a sustained period of drift and downside. How low may she go? My guesstimation in and around these levels. So you'll be looking from the 240s to the 260s as a guesstimate. If it doesn't come as much, it might be showing us that the next move from this compression could be an upside break. Yes, it could get more insane. But overall, with the inverted yield environment, I'm biasing more to, at some point, that. And eventually we break. But not as part of this down leg. We'll then get some support and do a bit of a rally first. So there's going to be a period of opportunity to sell to the downside. So what do you sell? Well, you could trade this and trade the S&P and just go short on that if you like. And have your targets, have your stops. Stop nice and close. Up top there. Entry shorts roughly there. I would look for a little rally into the entry shorts. Never trade at market. And then get down here. That would give you your risk as R and your reward as the better kind of R. The more fun, the green reward. That's decent, and you can play with that. The alternative is the fundamentals. We know where the bodies are bloody buried. Subprime cars, subprime students, or everything that's financialized. 72 months to pay off your Ford Bronco truck, F350. Think of all those second-hand cars going down in value. Think of all the stuffed dealers in terms of the manufacturer stuffing the dealer pipeline and having to do deals. Banking fear in financial services and banks again. That's going to be an issue. Student debt, subprime student debt. Wow. Careful out there. REITs, property, real estate investment trusts. There could be equities in there that could set up for down legs that could be attractive. Remember, it won't necessarily be the full-blown one, but you'll get significant sell-offs between 10, 15, and 20%, possibly some even 25, just in the S&P moving down there. Then when it rallies, you'll get a degree of comfort before we can go potentially for the entire stock market to lose 40 to 60%. If it's the great one, the major reset, reset sniper, who knows? Who knows how far we could go? Okay, bear in mind, it could also go up. They could just go crazy and print 10 quadrillion dollars, in which case, a dollar just isn't the same dollar to what we're aware of and used to. So that is the opportunity for you guys. That is the opportunity. Another sector that I think might get a little bit of a shock, and I've done this on YouTube. Tilray, it's already broken. So when I YouTubed it, we were up here. Let's do the draw again. And our community is in on this one, and you could just short it there. It's now there, made some progress, but the overall look is to lose from the better part of when you could have shorted it in the upper 79 range all the way to 36. Pick yourself up 55%, and that could all occur in just the down leg that we're referring to here for cannabis, because it's a hype factory. It's a hype factory. That's right. Kind of like the cryptos for equities. Yes, that's it. So there you go. You've got some ideas where to look for your shorts. You've got some ideas where to look for your shorts. You can come and see us implement them. All you have to do, 50 Market Sniper YouTube guys will get free trading session. Not only one session, 2 sessions with me with a half-hour break, 90 minutes, half-hour break, 90 minutes. And we'll see the non-farm number in the traditional markets, and we'll peek on the other side on the virtual crypto markets. So go and join the group, the details below. Ask for the invite. Yes, 50 of you. It's 50 number. I'm getting an old guy now. Thank you for the happy birthday wishes to those that have come in early. We look forward to having you all. This is the group, the Market Sniper group for Total Trader Transformation. I could have kept it short, but then that would be boring. Links in the bottom below. Hope that's given you some brain food. Appreciate you for liking and sharing. If you liked it and you felt it's worthy of a share. Otherwise, just enjoy it, chew it, and consume it and do whatever you want to do with it. Catch you later and look forward to interacting with you further and seeing you on the Facebook group. And Non-Farm Friday on the 5th of April. We'll send out GoToMeeting links and we're giving big numbers away. So we look forward to seeing you all as part of that. Thanks for watching and catch you later.